Hi there, this is Alexis Asadi. I appreciate you joining me on this teleclass. I'm going to try to keep it under 20 minutes for our first call. This is going to be an introductory call. So we'll talk about some high-level concepts, and then going forward, we'll try to hammer out some of the more nitty-gritty details. But for this first call, I'm going to talk to you about an investment that I've been making since 2013. It's an investment that has done extremely well for me. It's one that still today comprises the cornerstone of my portfolio. And this investment has been around for hundreds, if not thousands of years. So I presume, for the rest of my life, I'll continue to make this investment as well. Probably from my perspective, every investor has, over the course of their career, they come across an asset that serves them best. For some people, they do really well with currency trading or trading stocks or, flipping homes or, whatever the case may be. But this has been an asset that I've been able to find a really comfortable nexus between high returns, low risk, security, continuity, and probably, at least most importantly to me, is passive income. It's been an investment that pays income to me every 30 days. So long as the investment performs, I know exactly how much money I'm going to make. There's not a whole lot of guesswork to do. For that reason, it's something that I remain passionate about, and it's really difficult for me to find things that can outperform this particular asset. So today I'm going to talk to you about the world of lending. That's what this magical, mystical asset is. And more specifically, I'm going to talk to you about mortgage lending and how an investor like you can get involved in deals like this yourself. So a lot of people don't realize that, making lending-based investments are available readily to regular investors like you and me all over North America. You don't have to be a bank or a multi-billionaire to participate in these kinds of investments. You don't even have to buy into like an investment fund that does mortgage lending. That you can actually make these investments yourself directly. You as the lender can make this type of loan to a borrower. You can make a mortgage loan. You don't have to go to some fund manager to make this type of investment for you. And this is something that a lot of people don't realize because, obviously, the lending world is really lucrative. That's why banks are, the biggest and wealthiest and most powerful institutions in the world. But people don't realize that they can participate in this directly. They don't have to, buy into some secondary asset, and So that's kind of what I want to talk to you about, and this is what this series is going to be about going forward. As I say, with this call, it's just going to be an introductory call. We'll talk about lending in general. And then going forward, we'll start to talk more about the nitty-gritty details and how you can find these investments yourself, how you can make these yourself, how you can structure the deals yourself. There's a whole mountain of material that we can go through. But let's just start kind of today from a 30,000-foot view perspective on what lending is, what mortgage lending is, and how an investor can earn a financial return. So, as an example, let's say, I'm an entrepreneur, right? Let's say I need $100 and I want to borrow $100 from somebody because I want to go invest into marketing for my business. I know that for every dollar that I spend on marketing, I can earn $4 back in sales. So it's really just a function of how much capital I can get. So I go and I approach a lender, or I go and approach an investor like you. And I say, hey, can I borrow $100 from you? And you say, yes, sure, you can borrow $100 from me. You qualify me, you look at my earnings, my income, you come up with an appropriate risk assessment, which we'll talk about in a later call. But you say, sure, you know what, Alexis, I'll lend you the $100. I think that you're, a reasonably capable entrepreneur, and I'm quite confident that you'll be able to pay me back my $100. But in exchange for my $100, I want you to pay me interest at a rate of 10% a year, every year until you pay me back. And in fact, Alexis, I want you to pay me back within 2 years, within 24 months. So you're going to get my $100, but you're going to pay me interest at 10% a year, every year for 2 years, and you're going to make those interest payments to me monthly. And I say, great, that's a sweet deal, because I know that if I receive your $100 and I go invest it into my marketing ideas, and I can generate $4 for every $1 that I get, I know it's a great deal for me. It's well worth it to pay the 10% interest. So we do the deal, and I receive your $100. You've parted ways with your $100. We sign a loan agreement or a promissory note or some other instrument to evidence the debt. And I begin to make my interest payments to you beginning 30 days later. So you, as an investor, you now no longer have your $100. You've deployed that into an asset, being me, the entrepreneur, the borrower. What you now have is a stack of papers that evidence the debt. You have legal agreements that show that I owe you money. And you now have an income-producing asset. I am now your income-producing asset because I'm making interest payments to you every 30 days. And that, my friends, is really the premise of a lending deal. It doesn't matter whether you're doing a deal for $100 or $1,000 or $100 million. This is really the asset at play. Now, obviously, these deals can become a little bit more complicated. It's really not as simple as just here's $100 and you give me some interest. Loan agreements have all kinds of terms and covenants and provisions. But generally speaking, this is really a pretty simple business to be part of. It's not like we're investing in some random technology company and there are all kinds of variables. This is really what it is. Now, the type of deal that we just explored is it's called an unsecured loan, because the loan is not secured by any piece of asset. So, or excuse me, any particular asset. So let's say I can't pay you back. Let's say, I run into financial difficulties and I can't afford to make my interest payments to you, or I can't come up with the principal amount, the $100. Or let's say I run away with your money and I don't come back. Or let's say I died and I can't pay you back. There's no particular asset that you've secured this loan against. You've issued what's called an unsecured loan. What you can do is you can take me to court, and you can get a judgment against me, and then you can take that judgment and find out if I have any pieces of real estate that you can seize, or you can go to my bank and collect the money that I owe you. But it's not against any one piece of real estate or any one asset. It's a general debt that I must pay you. Now, just a brief disclaimer, because I know that there are going to be some people who are a little bit uncomfortable with the notion of taking legal action, going to court, seizing people's assets, and so forth. But this is an educational call, and I want to make sure that I can give you as full of a perspective of the lending business as possible. And just like any other business, any other investment, it's important to know, your rights and options under the law. But when it comes to legal action, it's really important for me to emphasize this to you, that this is the worst case scenario. This is the last end of the road option. And there are a ton of steps that would have to happen before most lenders ever want to get to, going to court or anything like that. First of all, it assumes that the borrower has stopped paying you, right? It assumes that your loan is no longer performing. The borrower stopped making payments to you or has violated your contract so badly that you as the lender say, look, I need to call in my loan and get my money back. But then even after that, it then assumes that, okay, your borrower is messing up on his or her payments, or if it's a business, its payments, and then there's no more room for negotiation, right? There's no room for sitting down and coming up with an agreement, coming up with some sort of extension, some sort of flexibility, some sort of way to make the deal work. It assumes that the borrower has imploded so badly on you that there is no more option for you. You've really reached the end of the road. You can't come to any sort of agreement with that person. Maybe the person is totally MIA, not willing to communicate with you, and you really said, look, I've got no more options available to me. I have to take legal action to protect my capital. And the nice thing as a lender is that you do have recourse. You do have a final option to protect yourself. But certainly in my experience, it has not been the cornerstone of my business. I can maybe think of 1 or 2 times since 2013 where I've ever gone to court, right? First of all, the vast majority of my loans have performed, right? Obviously, I'm not in this business to make bad loans and lose money and all that. But even with most of the loans that I've had some problems with, so you then take that space of bad loans that I've made, the small fraction of my loans that didn't work out that well, even with those loans, for most of them, I've been able to come up with new terms, negotiations, new agreements, and make it work, right? It's only been the tiny segment that I've just said, look, I've got no more options, where I've had to actually go to court and compel the borrower to repay me. But I have never had to foreclose on somebody's home. I've never had to seize anybody's assets. It has never gone nuclear for me. And for many borrowers, I assume for many lenders, and I assume for the vast majority of lenders, none of us ever wanted to get to that stage, right? We just want stable loans that perform. So it's really important for me to make that clear to you. We're not in the business of loan sharking. We're not in the business to rip people off and make their lives hell. That's certainly not a space that I'm comfortable with. And I'll talk about, some ethical considerations later on in this call as well. So, this whole conversation about legal stuff, it applies both to unsecured loans, which we just talked about, and, now I'll kind of go into what a secured loan is. A secured loan, and particularly in this conversation, is a real estate backed or real estate based mortgage loan. So this is a loan that is tied and secured against a specific piece of real estate. So if we go back to this example of the $100 loan that you've given me, after signing several other documents, which I'll talk about in later calls, you'll be able to say, well, look, Alexis, you can have my $100 and you're still going to pay me my interest rate of 10% a year, but I want you to pledge your home as collateral so that if you don't pay me back, for whatever reason, my loan is secured against your house and I can foreclose on your property and I can seize your property in order to recoup my money. So this is the essence of what a mortgage loan is. So as an example, if I can't pay you back the $100, what you could then do is you could go to court and you can get the judge to say, yep, Alexis didn't pay you back. He violated all these terms of this agreement. And so what you can now do is you can seize Alexis's house and you can sell it and you can recoup your $100 plus any interest that Alexis owes you, plus any fees that Alexis owes you, plus any legal bills that you spent on going to court and going through this whole process. You can also recoup from the proceeds of selling the house. And that's really the essence of a mortgage loan. It also stops me from selling my house without you knowing. So as an example, let's say, we do this $100 loan and then 6 months later, I decide to go and sell my house and move. When I sell my house, I have to then use the proceeds of the sale or from the sale to pay off any debts that are attached to that house. So I can't just go and sell it, take my money and walk away. I've got to pay you out because there's a lien or a mortgage or a security interest that's attached to that house. And so, this is really the world of lending. This is a business that banks obviously are major participants in. And there's a reason for it, because when you attach a loan to a piece of real estate, you have that inherent security of having a hard asset. Now, not every, obviously not every real estate based loan or not every mortgage loan is super safe and ultra guaranteed. There is a degree of, research and due diligence and finessing that has to go into this. You have to be able to qualify borrowers. You have to know, how to structure the deal. You have to know how much money you should be lending based on how much in assets the borrower has. But there are steps that you can take to structure your loan in such a manner that, you have a ton of security, you have a really high amount of income that you can earn from the investment, and you have an investment that is reliable. And so these are really enjoyable deals for me to make. And a lot of people that make these kinds of investments, what they most appreciate about these types of investments is that they can structure the deal to be as beneficial for them as possible. Otherwise, they don't have to make the investment. So as I say, this is our introductory call. So we're just kind of talking about things from a broad point of view. As I was saying earlier on, a lot of people don't realize that they can make these investments themselves. And as I say, you don't have to go through a bank or like a mortgage fund or a lending fund or any of these peer-to-peer lending platforms. You can yourself find a borrower and participate in these deals. You yourself can have mortgage documents and loan agreements and participate directly without having to pay all kinds of fees and all this. And so that's what I'm going to focus on in the upcoming teleclasses that I do with you. We're going to talk about probably, at the top of people's minds is how can I participate in a deal like this? How do I actually find a good deal? How do I find somebody that wants a loan, and why are they going to me instead of a bank? And if they're going to me instead of a bank, is there a problem? And what you'll find actually is no. A lot of the times there's not a problem. There's a huge market of credit-worthy borrowers, entrepreneurs, real estate investors, people that are talented, people that know how to create wealth, but they need private capital. They're not looking for bank financing. We're going to talk about how to structure deals. We're going to talk about things like loan-to-value ratios. We're going to talk about first, second, third, fourth mortgages. We're going to talk about how to maximize the interest rate, how to find borrowers that are not just people looking for money, but people that really qualify for your money, how to make these deals as secure as possible, and even in some cases, how you can sell your loan, how you can exit and create a degree of liquidity. So, a common misconception is that, well, if you're a lender, you're basically stuck with your loan until, the person pays you back. But actually, you can sell off your loan agreements to other buyers. There's a whole market out there for that as well. So we're going to go through these, in the coming calls. This is a introductory call. Right now, we're approaching the 15-minute mark. But as I say, this is an investment that has done very well for me. It's one that's created a ton of passive income for me. It is still the cornerstone of my portfolio, and it's one that will probably continue to be the cornerstone of my portfolio because it has done so well. And it's one that I want to share with people because I think it's something that investors like you, retail investors, you may not necessarily be worth millions and millions of dollars. Maybe you are, I don't know. But normal people like you and me can make these investments directly, going from borrower to lender. It's just a function of knowing how to do it. And the nice thing is that a lot of this stuff is relatively easy to learn. Even all the legal stuff, hiring lawyers, like doing all that. It may seem like a lot of work to somebody that is new to this space, but after a short while, it really can become like second nature. One topic that we'll also discuss is the ethics of lending. For me, the ethics of lending are quite important. Maybe other investors don't care as much, but you've probably heard of things like loan sharking, and there's certain stigmas attached that are attached to lending. Personally, I don't participate in deals like that. I'm not trying to do business with people that are desperate for money and I'm ripping them off, charging crazy interest rates. Personally, I choose to lend to businesses, to entrepreneurs, to people that are growing, people that might be hiring people. They're looking to build stuff. They're looking for working capital. These aren't people that are like in dire straits and are desperate for money and will pay 400% interest, right? Although some people, some investors do like to play in that space. And so we're going to talk about the ethics of lending as well, and how that should or even should not, depending on who you are and how you choose to do business, fit into your portfolio. So I appreciate you being on this call. This is our first teleclass about the world of private lending and mortgage lending. On the right-hand side of the screen, or unless you're looking at this from your smartphone, so it's going to be elsewhere, but somewhere on the screen is going to be a box that basically says, look, if you want to work with me a little bit more on learning how to make these types of loans, just submit your contact information. So I'm going to ask you for your name, your email address, your phone number, and I'll reach out to you, and we can talk about me helping you structuring these deals yourself. Otherwise, I look forward to seeing you on the next call, and we'll talk again soon. Thanks a lot.